losses above it. This creates what we call a buy-side liquidity zone, an area full of orders waiting to be triggered. Now look closer. This level is also obvious. Anyone opening this chart can see it right away. And when a level is obvious, it becomes crowded. The more visible it is, the more orders it attracts, and that means more liquidity for smart money to target. Another key trait? This level was recently respected. Price reacted here just a short time ago, which gives traders even more confidence that it'll act as resistance again. So more sellers enter, and more stop losses get placed just above. Now watch what happens. Price pushes up, breaks just above the resistance, sweeps the buy-side liquidity, and then drops sharply. That's a textbook liquidity trap. Smart money triggers the stop losses and breakout buys, fills their sell orders, and reverses the market. As a smart money trader, your goal isn't to predict the breakout, it's to wait for the trap. Once you see price sweep above the level and then close back below it, that's your entry signal. The first type of liquidity we covered is stop loss liquidity, found above resistance and below support, where retail traders place their stops. Now let's move to the second type, imbalance liquidity. What is imbalance liquidity? It forms when price moves aggressively in one direction, creating a clear imbalance between buyers and sellers. These fast moves often leave behind unfilled institutional orders, turning those areas into liquidity zones. When price returns, smart money uses these zones to complete unfinished business, filling leftover orders, reloading positions, or trapping retail traders. These areas are known as supply and demand zones. A demand zone forms after a sharp move up, leaving unfilled buy orders below. A supply zone forms after a sharp move down, leaving unfilled sell orders above. Smart money often brings price back into these zones before continuing the move, either to trap early entries or collect more liquidity. But not all supply and demand zones are created equal. Some are strong and reliable, others are weak and noisy. The difference comes down to 3 key filters. Master these and you'll stop wasting time on low-quality setups and focus only on zones with true imbalance. The first sign of a strong supply or demand zone is the size and consistency of the candles in the move. Large, clean candles in the same direction suggest institutional activity. Small, choppy candles with lots of wicks? That's noise. Skip those zones. Freshness of the zone. Only trade zones that haven't been touched before. The first test is usually the strongest. Once price revisits a zone, it gets rejected and the market reverses strongly. Break of structure. A strong zone often forms after a break of structure, like a previous high or low. These breakouts are not random, they signal a shift in control, often led by smart money. Zones formed right after are high probability. Now, let's apply this on a real chart. We're looking at the British pound US dollar 15-minute chart. The market just made a sharp move upward, creating an imbalance zone. Why is this important? Because strong one-sided moves often leave unfilled institutional buy orders behind. Smart money may return to this area to fill those orders before continuing the move. But is this a high probability demand zone? Let's apply the 3 filters. Filter number 1, candle size. The candles in the move are large and consistent, a clear sign of institutional momentum. Filter number 2, freshness of the zone. The zone hasn't been tested yet, which means the first touch could trigger a strong reaction. Filter number 3, break of structure. Looking left, the move broke a previous high, confirming a shift in structure and adding strength to the zone. With all 3 filters in place, this is a high-quality demand zone, a strong liquidity level we can trade from. So we mark the zone and wait. Watch what happens. Price pulls back, taps into the zone, fills the unfilled orders, and explodes upward. As smart money traders, we wait for confirmation. Like this rejection wick showing buyer interest at the zone. That's your signal to enter and follow the move. Now let's look at another chart example. This is the Euro US dollar 15-minute chart, and the market has just made a sharp move downward. This strong drop creates a clear price imbalance, making it a potential supply liquidity zone. But is the zone valid? Let's apply the 3 key filters. Candle size. The candles in this move are large and consistent, a clear sign of strong selling pressure from institutions. Freshness of the zone hasn't been tested yet. That means it still holds unfilled sell orders, and if price returns, those orders could drive the market back down. Break of structure. The move broke a previous support level, confirming that this wasn't just a pullback, it was a structural shift driven by smart money. With all three filters in place, this is a valid supply liquidity zone. So we draw the zone and wait for the price to return. Watch what happens. Price moves back up, taps into the supply zone, gets rejected, and then drops sharply. That's exactly how smart money re-enters the market and how we position ourselves with them. Now let's move on to another type of imbalance liquidity zone, the fair value gap. So what is a fair value gap? A fair value gap is a price imbalance created when the market moves aggressively in one direction, leaving a gap between candles where no transactions occurred. This gap represents inefficiency in the order flow, an area where buy or sell orders were left unfilled. Smart money often returns to these zones to fill those missing orders. That's why the fair value gap is considered an imbalanced liquidity zone. It holds resting liquidity that attracts price for a retest. For traders, it becomes a high probability area to anticipate reactions and enter with precision. How to spot a fair value gap?